Welcome to the daily update. This is being prepared Wednesday, October 19th, where we'll look at the action in the market today and then see how things look for Thursday, October 20th. And even though it was a down day, it was kind of a good down day, and I'll explain that as I go through the video. We weren't down in any real severe action, even though a down day is a down day, but we were kind of getting a little bit ahead of ourselves in the short term, especially. And with the down day, we worked a bit of that off. But now we need to see, this is the tipping point, at least for the very short term. Can we go up from here, or is this the beginning of more declines? Because we need to see follow through price action if things are going to turn back more positive. We have some of the setups, we have some things that are on the table that we can use to support higher prices, but unless the prices actually move higher, they don't do us any good. And incidentally, you might hear some background noise as I'm doing this. No, they are not machine guns, even though it might kind of sound like that. At least I think they're not machine guns. All right, so let's go back and talk about what happened. Right at the open, we did have a lower open, not a real big gap to the downside, but we rebounded to the daily pivot, which was at 37.23. And then this acted as resistance. We just peeked our head a little bit into positive territory because the pivot and the unchanged level were really close, but just very, very briefly. So once we got to that level, prices then started to go back down. They retreated to below S1 at 36.83, and then they rebounded back above S1. So it was kind of another choppy day overall. Then we drifted sideways going into the close. So it wasn't really decided. People are just kind of stepping back and saying, okay, are these advances that we're seeing, are they real, or are we just going to get faked out like we did last week? We ended up being down 0.67% on below average volume. That's another interesting thing, is on a down to sideways type of day that volume actually dropped off. We're still developing more positive things technically, but especially in the intermediate term and the long term, we're still negative overall. We haven't recaptured anything other than the 20 period moving average. The oscillators are showing that we're turning up that way, but some of our other indicators, although they're improving, haven't really switched over to a more positive tone because of the whole inflation and interest rate scenario that's dominating the markets currently. We still have the Russia-Ukraine situation, which again could escalate into something even worse than it already is. Things seem a little bit better in the UK right now. We'll have to see. It's kind of been an every other day type of thing going on there. And earnings are starting to come out, and there'll be a lot of earnings that are due out on Wednesday that could have a real impact on the market. And then we had a little bit of Fed speak yesterday that I'll go over, and we may get some more going forward from here. So some comments. Rising interest rates, that's what really pushed things lower in Wednesday's session. As interest rates are going up, that is becoming more and more of a problem for stocks. And then here's the Fed speak, where we had the Fed president Kashkari, who I guess will be a voter in 2023. He said that he could argue for the Fed funds rate to go above 4.75 if he doesn't see any improvement in the core inflation. Remember, we get the CPI, that's the headline number. Then they take out food and energy, the things that you really need. And then they recalculate it again. And that tends to be the inflation rate that the Fed fixates on. So they might even be willing to bump this up a little bit. The terminal rate where the Fed will top out. You remember when it was a lot lower than it is now? Well, they just keep having that go up and up and up. Earnings that came out in Wednesday's session were generally better than expected, but this didn't really help give a lot of support to the market. We had Netflix, Travelers, United Airlines, ASML. They all came out with earnings that were seen as pretty positive. The 10-year note that's what's going up here. We were at 4% yesterday, or we're at 4.13%. after Wednesday's session. And then the yield curve that went inverted, the 10 to the 3 month, no, it slipped back into more of a regular type of yield curve now. It only went inverted for that one day, but it's not very far being regular. Okay, if things start to get really crazy, it could easily drop back down and become inverted again. But we still have the 10 to the 5, the 10 to the 2, and the 30 to the 5. Sentiment is still camped over in that fearful area, not extreme fear, but still fearful nonetheless. And then oil prices, they ended up going up. And this is what's going on right now. There's this pre-election, I'm calling it a political ploy, because this could really make the U.S. vulnerable, because they're tapping into our strategic petroleum reserve that's only supposed to be used for an emergency. An election is not an emergency. But what they do is they can flood the market, and some of this is even going to be sold overseas, from what I can understand, to China. But I haven't been able to confirm that myself. That's just something that I read about. But the idea is that if there's more oil in the market, that will drive prices down. They're really trying to do that ahead of the election, because they can say, look, under us, the gas prices are coming down. Vote for me, vote for me. Well, yeah, okay, it's a trick, and both sides do it. But what if something happens? We're in some real peculiar situations right now with NATO, with Russia, the whole Ukraine situation. Things are just not real friendly right now. And if something were to develop where our military needed that reserve and it's largely gone, that could really hurt the US. That could put us in a very bad situation. Anyway, just know that that's still in play for right now. We did have the applications for mortgages. They declined 4.5%. Last week, we saw a 2% decline. The housing starts came in at minus 8.1% on a month over month basis. And then they seasonally adjust this to an annual rate of 1.439 million units. They expected it to be 1.465. So a little bit less than what they had been expecting. Building permits actually rose, and this can be used as a leading indicator. They were up 1.4% month over month to 1.564 million, and that's a little bit higher than what was expected at 1.550 million. Our trend is negative and weakening. It's starting to drop a little bit below the moving average, but we're still above 20 overall. I have our bias back to mixed, because there are some possible positive things that could happen if we see prices advance and close higher in Thursday's session. But if we don't get that, we're going to slip back into the more negative bias. And I have our momentum as a mix now too, because we've had some really bad down days. Well, we've also had some pretty good up days, and we're still kind of at a tipping point of where do we go from here. Here's just an update with our crazy little coincidental World Series indicator. Right now, the series between the Phillies and San Diego is tied at 1 game apiece. This is not the World Series. Whoever wins this, and I did change it to NLCS over here. That was my dream, that the Mariners would be in the ALCS, but that didn't happen. But whoever wins this goes to the World Series. So we'll just have to see if that ends. And I'll probably keep showing this unless the Phillies get eliminated or they lose the World Series. Let's go back and talk about the session. We're still right in about the middle of the fear area. So sentiment is starting to improve, but we're not out of that fear camp yet. Here's another look at the active asset managers. I try to report on this every week in the weekly video. Well, this also takes the S&P 500 chart and puts it over top. And you can see when we've had really extreme readings, that has often marked a low in the S&P. Well, we've had what, 1, 2, 3, and this one could actually be counted as 2, because we came down, came back up, came back down. The active asset managers, and these are the professional money managers who are human beings too. So they have a tendency to do things by emotion, and they have customers who lead by emotion. And if the market's going down, they're on their phone saying, "What are you doing with my money?" And so the takeaway from this, though, is they have been pretty extreme negative for quite a while, and sometimes that can give some support to the S&P. Another thing is, it says the S&P only takes out the 200-week moving average if there's a recession. Now, yeah, we did drop a little bit below that, but now we've come back above the 200-week moving average, and we're still above that. And see, in times past, the times when we really darted down below the 200-week moving average, these pink areas, these are all recessions. And of course, there's still the debate going on. Are we in a recession now? In a textbook sense, yes, we are, because we had 2 negative quarters of GDP. But because the employment situation is still pretty strong, a lot of people are saying maybe we ought to modify our definition of a recession. And so this officially hasn't been marked over here yet, but we're still hanging out just a little bit above the 200-week moving average. And I'll show you that later in the chart as well. This chart is just suggesting that cash levels are still pretty high. A lot of people have really tried to guess what's going to happen in 2022, and they've guessed wrong. If they see the market go up a little bit, they're like, I'm not really believing this, I'm staying in cash. Or people get out after they've seen pretty significant losses, and so they're just staying on the sideline right now, not really knowing what to do. This next chart just shows how the strength in the US dollar compared to all these other currencies is a large part of the problem that's going on, not only with giving some headwinds to stock prices, because the stock market likes a weaker dollar, mainly due to conversion rates and import export advantages and disadvantages, but it's causing issues in other countries as well. And so that could ultimately, in the bigger picture, feed more into some negativity in the US, because if things are really suffering, and we've just seen how they acted in the UK and how that affected the EU and how that affected stock prices here. Well, what if the EU starts to run into more trouble? What about Japan? What about some of these other countries? That could really feed into a negative economic environment with the dollar being so strong. Another thing, and this is very subjective, they call it a heuristic approach. That's the approach that I take with teaching. Is I try not to tell people what's right, what's wrong, what to believe, what not to believe. I try to present the facts and then let you come to your own conclusions. Sometimes you have to be a little more hands-on telling people about things, but this chart, some people might think we're at a different place than where this red circle is at. But if this is correct and we're coming down, this is the basic economic cycle where we had been going up and now we're rolling over. They figure that we're in phase 3 in the late cycle, where you focus on dividends, higher quality stocks, and lower risk. Well, that's been happening in 2022. Well, eventually we're going to come back down out of this, where we're starting to get into high quality, low risk, and larger size. You kind of double down on all of that before we start to turn up. Now, I've seen other folks come out and suggest that maybe we're closer to the bottom here. Other folks who are a lot more pessimistic, they think that this whole downward slope, we're just getting started with all of that. So this is just the Bank of America's interpretation on how they see things right now. Then most people are long the US dollar. And I mention this every time we see this chart. You can get futures contracts on the dollar. It's not just a matter of putting your money in a money market, which, as long as you stay in the US, that doesn't really help you all that much. But if you do a lot of traveling, like going to Europe or the UK right now, is very advantageous if you're converting US dollars. But there are trading vehicles where you can benefit from the dollar. And as of October, that's where most people are at right now. And it was still pretty heavy even back in September, where there is an increasing number of folks that are shorting the EU equities because they've been having problems there. And then long the ESG assets, that's a whole nother ball game with things. The people that are in oil, not as much as it had been in September, and they're short China debt and equity. Well, they're starting to see some more problems in China, with the continuation of the restrictions and the supply chain issues and some of their economic reports, they're like, yeah, we're not going to come out with some of our reports right now. We'll tell you when we're ready to. And then there's also an increase in those folks that are shorting bonds or bills in the UK, as well as stocks, and very small who are short the high yield bonds. Those would be like junk bonds. But the dollar is really, that's been where a lot of people are getting into. Well, when you have the whole crowd going in the same direction at the same time, sometimes we define that as a bubble. Can that produce some problems for the dollar going forward? It hasn't so far, because this has been pretty strong this way for a lot of 2022. But when everybody goes in one direction, that's when we want to start looking at going in the opposite direction. Another thing is, this just suggests that market liquidity is deteriorating as this is going down. That's just bid ask prices, people active in the market. And that's a big thing. That's why I focus on the S&P 500. And that, if you've taken my course, I have a whole section that deals with liquidity, the ability to get in and get out quickly, where was even some high volume stocks, some of the more advanced strategies that you might implement, you're not going to get filled either to get in or to get out right away, where you can get filled a lot quicker with S&P 500 strategies. And that was a big deciding factor for me. So this is kind of important, is that liquidity is kind of drying up. There's not as much activity actually going on. This chart just kind of shows what we talk about pretty much every day, is the S&P is negatively correlated to the rise in rates, in interest rates. This is the 2-year yield, and they show this. It's actually, I think my chart makes a little bit more sense, but this just shows how the correlation of daily returns has been going down as interest rates have been going up, basically. Here's another one, and I don't really see this capitulation that's starting here. That's the yellow, my goodness, yellow. I know my colors here. The light blue line is coming down, and this is the percent who say short-term rates will be lower in 12 months. You're getting less and less and less. Well, down here, the percent of folks with the dark blue line that are expecting higher global CPI, well, it's kind of getting pretty extreme right now. But these are pretty far apart from each other, where they have a tendency to move more in correlation with each other. So what's going to happen? Is the blue line going to keep coming down? Is the dark blue line going to start coming back up? The RIDEX bull bear ratio, since we had 2 days in a row that were pretty good up days, after really spiking up, a lot of folks are starting to get out of the bearish funds and getting more into the bullish funds. But again, these folks have been really ping-ponged at exactly the wrong times. This is still a pretty high reading, but we spiked up here. And sometimes when you look at this kind of like you would the VIX. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. Well, this is really spiking up similarly to the VIX and even our equity put call ratio. So this could just suggest that maybe we've topped out on a sentiment basis. And growth did underperform value in the large caps, mid caps, and even in the small caps. So we were down across the board there, where the VIX turned up just a little bit on a closing basis, and we closed kind of near the bottom of the bar because we were down further than what we had been earlier. And so we're seeing the VIX really starting to trail off after giving us a pretty high reading recently. And the VIX of the VIX also is continuing to fall. The Ulster Index daily chart, just kind of hanging around, where I think it's more indicative of the weekly chart here that shows the fear is still pretty strong. This lines up better with our fear and greed index. We're down 23.31% from the all-time high. And the equity put call ratio on the daily chart, it did go back up with the down day, but it's not giving us an extreme reading. Kind of flattened out over the 5-period moving average that we use. after coming off of this spike. And again, I have the longer term chart near the end of the video that I'll show you. Here are the support levels for the daily chart, which have been posted on the YouTube channel. Here's the daily chart showing how we'd come back up to the pivot point that acted as overhead resistance, and we're coming back down. But we closed well off the low in Wednesday's session. So, and we're still above this longer term support that we've been watching. And you can see at the bottom where volume really dropped off. And we're kind of in no man's land right now with the longer term fib chart. If we start going up higher, can we get above these two Fibonacci retracement levels that are right on top of each other? And then our long-term fib chart, where we broke down below the low set in 2021, and we were able to come back above that. Well, we've dropped down a little bit below that right now, but we're still above the June low. Here's the weekly chart. This is the one I'm probably watching the most. Here's the 200-week moving average. We are still above that. Can we get above it? If we do start to go higher, will we run into resistance at this 38.2% retracement, which is at about 38.19? And then we're coming a little bit back up more to the midpoint with our trend channel. Just want to make sure I didn't miss one. The sectors, let's see, 9 out of the 11 were negative, with real estate leading the way lower. Financials, which have been coming on a little stronger lately, they were also down. We had communication, just it was barely unchanged, and then energy was up. That was the one really strong sector in Wednesday's session. And we still have the energy sector looking best on a technical analysis basis with the scooter score, with real estate being down at 6.4. It's looking the worst on a chart basis. And we're picking back up some gains that were lost in the energy sector. If you go back to the all-time high set in the S&P, now we're up 47.15%. My goodness. Utilities have now gone into second place, even though they're down. And then all the other sectors, with communication being in last place. And here's just an update of how the other indexes have performed since the S&P hit its all-time high. Technical alerts, some positive, some negative. The NASDAQ fell below 10.7, then below 10.6. The S&P fell below 3,700. But then on a positive side, the NASDAQ got back above 10.8. We had a cyclicals BPI cross below 50. That's a negative. And then communication, we had the BPI cross above 30. And remember, communication, that's the sector that's performing the worst these days. And that's, if we can really get some improvement in that sector, that will help the growth part of the equation. Our scores show that the Dow is in first place at 75.7. So that's showing some improvement. Mid caps are in second place at 63.6. Small caps in third place at 61.5. The S&P is still below 50 at 48.5, and the Qs, even though they're improving, are at 26. Here's our intraday look. Really didn't have a gap from Tuesday to Wednesday, but we shot down lower. We came up to the pivot, which was just about at the unchanged level. Tried to peak above this just a couple of times and go positive, but that didn't last for very long. Dropped back down, even dropped below S1 before going sideways, went back above S1, drifted down, went back up. And so there just wasn't an awful lot of conviction going on later in the day in Wednesday's session. Our trend is, you can see the ADX is starting to come down and it's dropping below the moving average. If you're more aggressive with this indicator, you are back to a neutral stance right now. If you're more conservative, you want to see this ADX come all the way down to 20 before we go to a neutral stance. Or if the red line can continue to decline and the green line going up, if these lines can cross and then the ADX goes back up, that would then be a positive trend. But for right now, the red line's on top, so that's a negative trend. The Arun is still trying to show a little bit of improvement after giving us an extreme negative reading. And we saw a little bit of a decline with the advanced decline line based on price and volume. And also a little bit of a pullback with our advanced decline ratio. New highs, new lows. They've been holding up. That's because nothing is really happening here. We're just kind of bouncing around where we were at not very long ago. So we're not seeing a real expansion of new highs or new lows currently. But if we break to the upside, this green will really start to shoot up. And even if we start to drop, it's going to take a while for us to show a lot of new lows right now. But we're still headed a little bit higher with the 5 period, and we're pretty much flat with the 10 period average of new highs minus new lows. We're still below a declining trend line with accumulation distribution. Short term, we're still kind of in no man's land right now between the space between the simple and exponential moving average calculation. We're kind of right in the middle right now. Rate of change, after giving us a slight extreme positive reading, has dropped back down a little bit. The Stochc RSI continues to be extreme positive, although it is turning down. Williams percent R turned down a little bit, but is still above the midpoint overall. The force index fell a little bit, but is still positive. Swinland trading oscillator, this is still holding up. So this could be a leading indicator for us. Sometimes it's been insightful. We're advancing based on price and volume, even with the down day. McClellan oscillator, after just getting to the underside of an extreme positive reading, has dropped back down, but it's still positive since it's above zero. Saw a little bit of a decline with our 20, 50, and 200-day moving average study. The short-term stochastics coming down a little bit, but still positive, still moving higher in the intermediate term, and starting to get a little bit more positive with our longer-term stochastics. Intermediate term, rate of change going back 50 periods, we're still just barely in extreme negative territory, even though we're showing some improvement. The Sean trend meter, after coming out of an extreme negative reading, did show some more weakness. Here's the PMO. It has crossed over positive, both with the PMO, and then if you look at it just based on price and volume, that is positive. Our PMOs that are rising after giving us an extreme reading have come back down slightly. We're still positive with the buy signals, and we're showing some improvement with those PMOs that are above zero. Chaikin oscillator still continues to advance, even with a down day. Chaikin money flow, even though it had been negative, is turning up slightly and showing a little improvement. We are seeing a drop off in volume. The vortex, which turned positive yesterday, is showing the green line going above the red line. So that's positive still. The summation index has turned back after giving us an extreme negative reading based on price and volume, which sometimes leads the way. It's looking a little stronger. So that's positive. And let's see, I looked at this. All of our oscillators are pretty much positive now. They're crossing over positive, but we need to see follow through with price, or they're just going to hunch right back over. The BPI is above 30, which that was registered yesterday. Even with the decline, you can see that little teeny tiny red bar right there. So even with the decline, not a lot of new bullish percent index readings were generated. Ease of movement still continues to show improvement. Ultimate oscillator also showing improvement. Money flow a little bit higher to flat, showing some improvement with the TTM squeeze. Balance of power, a little bit of an improvement, but still underneath the dash line, and showing some improvement with our CMB composite index. Our charts, we're still hanging in there, looking more positive with the hike in ASHI. We're still negative with red lines here with the KEGI, but these red lines are going up. The Renko, this redrew after Monday's session with that open box and then a red box. And that is seen as more positive, where we had all red boxes going down before. So this is hanging in there looking a little bit better. Three-line break also showing some improvement. Nothing changed on the point and figure chart. We added these X's in here, but that we're not working off any kind of a signal currently. We are still positive with the Elder's Impulse for the S&P and the SPY. And then this was, to me, a kind of a big one. The SAR, the stop and reverse system, it generated a positive signal after Monday. The dot is still underneath, so that positive signal is still in force. The go no go is switched back to a pale purple now, which is more neutral with a negative slant to it. Long term, we saw a little bit of a decline with our 50, 150, and 200 simple moving average study. Rate of change, we're still trying to come up out of this extreme negative reading where we last got to during the COVID low, but it's going to take a while because 200 periods, that's a long time. So we're going to have to see if this can improve our long-term trend. Special K trying to turn up after getting just slightly down to an extreme negative reading, but still a long way to go till it gets to the moving average. The diamonds are still positive, and the Dow's holding up about the best right now. And we're still above the pivot with the Dow. And you can see its volume really dropped off as well. The Qs have switched back to neutral, so they're blue right now. And we're still below the pivot. And again, as I keep saying in the videos, we need to see the NASDAQ and the NASDAQ 100 really start to jet higher if that's going to bring the rest of the market along with it. And unless that happens, it's really going to be a struggle, or it just won't happen. The Vixen actually went up a little bit. It just ticked slightly higher. And here's the NASDAQ also below the pivot point. Can we see some strength out of this? Can we eventually get back to the point where we recapture the 50-period moving average? And it seems like dreamland now, but if we're going to turn around and go more positive, those things are going to need to happen. The mid cap's still holding up, and we're just about on the pivot, a little bit below it right now. The Wilshire also still below the pivot point. Dow theory, a little bit of a tick down with the Dow, the trannies, and the utilities after the utilities have been showing some real recent weakness lately. The dollar did go back up with stocks going down, so we're still in an overall uptrend. And the correlation between the S&P and the dollar, they're still having a really strong inverse relationship. Gold, which is supposed to be going to the moon, should have already been to the moon by now, but no, it continues to fall. Same thing with silver. Currently, oil was up almost 3% to 84.52. Some of that they're blaming on the cause for that is that they're going to tap in to the strategic oil reserve some more, even though that pushed prices up. But eventually the government's going to have to replace what they take out of there, and it could be at quite high prices. The correlation between the S&P and oil, it's coming out of neutral territory with a slight bias towards going in opposite directions. Bonds were down 0.82%, so we're still seeing more weakness as interest rates go up. The world bond index continues to fall based on price. And here's our yield curve where the 10 to the 5 is still inverted, the 30 to the 5 is inverted, the 10 to the 2 remains inverted. And after just squeaking inverted yesterday, it's gone back up to 0.07 with the 10 to the 3 month. We'll keep watching this. The 10-year yield continues to climb. We're at 4.127% here. The 30-year yield, which is lower than the 10-year yield, is at 4.15%. And this shows how interest rates were really climbing. This is a daily chart with the 2-year yield still way in the lead. That's where you're getting your best return right now. Stocks and bonds have actually entered into more of a neutral correlation with each other. And kind of the same thing with the S&P to the 2-year yield. This is going back into neutral. So we're not really getting a lot from that. And we're pretty close to being neutral again with the S&P to the 10-year yield. And tech to the 10-year yield, still having a tendency to go in opposite directions, but this is moving up and could go neutral. Our scenarios, just to update these charts, saw a little bit of weakness based on price and volume after giving us this extreme negative reading. Those above their 200-day moving average, it really didn't change all that much. Those that are above their 50 saw a little bit of weakness in the S&P, the mid caps, and in the small caps. And the 10-day average of the highs and lows in the S&P, it hasn't changed either. So we're doing a lot of chopping around right now. Broad market, looking at the Amex, NASDAQ, and NYSE, you take a 5-period moving average of their highs minus their lows. They're still negative after giving us kind of an extreme negative reading. Here's the longer term chart of the equity put call ratio looking back 5 periods. We're still working off of this spike, which sometimes can give support to the S&P, and it really didn't change all that much right in here. The small cap index, even though it was down, it's still above the pivot level. So when we do a ratio between the small caps and the S&P, it declines slightly, which we still kind of have a little bit of a spike here, even though it did decline in Wednesday's session. Can that give some more support to the S&P, the blue chart? The sector rotation, it's not really doing all that well now. The Qs, they're going down and almost ready to take out this low if they haven't already. Discretionary, and they still haven't taken out that low yet. And the large cap growth to large cap value, they're still above the low. And then if you look at the large, mid, and small caps, they're still just showing not the strength that you would want to see. Now, this could change quickly, but it's been pretty weak lately. This is one area that is still fairly positive. The ratio between the S&P 500 and the utilities. The S&P is still continuing to outperform the utilities on a ratio basis, which could often provide support for the S&P. It can also mark tops, but my gosh, looking at a top right now seems like a luxury compared to all the bottoms that we've been having to follow in 2022. We don't know if this is spiked yet because the 2-year yield just keeps going up and up and up. The staples were down almost 0.5%. And so this spike that we're working off of is still valid right now. So this often gives some support to the S&P. But Wednesday's action didn't really help us in all that regard. We still have a signal that has been generated with the Copic curve, meaning something big could be in the works. Well, we're kind of getting far beyond when that signal was generated. But getting back to the Copic curve, it does not tell us the direction. Where the Pring bottom fisher, it does. And this is still a valid signal, but we need to see follow through with price. So what's our outlook then for Thursday? We're still improving with our technicals, but we need to see more follow through buying. It's ultimately going to come down to price. You can pick your bottoms. Sounds kind of disgusting, but you can try to figure things out and say, oh, I think we're at a bottom right now. You could get to a point where you think we found support and then you jump in. I like to wait until I see it confirmed by price. We're just not seeing that yet. We're going to need to see more. We do have jobless claims coming out. The Philadelphia Fed survey and the leading economic indicators will be coming out, as well as existing home sales. So we get more housing information. The whole list of geopolitical events. Right now, it's more inflation and interest rates. But as I always say, any one of these could sneak into the forefront, or a brand new one could make itself known, and that could end up having an impact on the market. So our scenarios, I'm still kind of mixed because we're still negative intermediate and long term. They're turning positive, but we need to see more buying. Yeah, we could go with the up scenario, but we need to see more buying. We're just not seeing that yet. And you might be able to make a sideways guess on the market right now because the ADX has fallen below the moving average, but we're still above 20. So it's really hard to know what to do with that one right now as well. So our conclusion, the S&P, it's turning positive if we see follow through buying. If we see more selling, it's going to turn back negative. Short term looking better, intermediate term looking better, long term still negative. So thank you. Have a wonderful Thursday, and I will look to prepare a video after Thursday's session. If it ends up being a yawner of a day and not much is decided, I may end up just doing the daily brief, but we'll just have to see how things go.